There's a dangerous myth in the startup world that to be a successful entrepreneur, you have to be a reckless, all-in risk taker. But the data tells a different story. If you look at the most successful founders in India today, they are not risk takers. They are the world's best risk managers. Hi, I'm Professor Barnabas, and over my 25 years of teaching marketing and strategy, I've seen that the businesses that last are the ones that manage their downside first. Today, we are dissecting the Zerodha Playbook. How did the Kamath brothers build a multi-billion-dollar empire without a single rupee of VC funding? I put together an AI-powered strategic overview to break down the mechanics of their bootstrapped growth and how they use the business of being boring to outmaneuver every funded competitor in the country. Watch this deep dive into their risk management model, and I'll be back at the end to help apply these principles to other startups. Let's look at the numbers now.
Let's set the scene. Picture a glass-walled boardroom in Bengaluru. On a giant screen, some key metrics that were once shooting for the moon are starting to level off. And there's this one question hanging in the air. It sounds simple, but trust me, the answer is anything but. It's a question that cuts right to the soul of the entire company. And there it is. That's the heart of the dilemma. I mean, if you've built your entire reputation on being a platform for people to make their own decisions, how do you step in and help them make better decisions without becoming the very thing you promised you'd never be?
And the need for this kind of help is, well, it's huge. A study by India's market regulator, SEBI, found that a staggering 93% of individual traders in the high-risk futures and options, or F&O market, lost money between 2022 and 2024. That's not just some random number. That is the brutal reality of the world Zerodha operates in.
Okay, so on top of that, you've got these other market pressures all converging at once. By mid-2025, the whole industry started seeing active client numbers cool down from those crazy pandemic highs. And at the exact same time, a major competitor, Gru, actually pulled ahead in terms of active users. The race was on.
So it all boils down to this one massive choice. Do you stick to your guns? Do you double down on that purist, no-advice identity that got you here in the first place? Or do you evolve? Do you listen to what your customers are asking for and adapt to a changing market, even if it means fundamentally changing who you are?
Now, to really get why this is such a gut-wrenching decision for them, we need to rewind and look at the very foundation of Zerodha's success. It was all built on one single, incredibly powerful promise.
See, Zerodha pretty much pioneered the whole discount broking thing in India. They were bootstrapped, meaning no outside investor money, and they were absolutely obsessed with technology. They took the old school broker model and just stripped away all the extras, the research, the advisory calls, to focus on one thing and one thing only, building a super clean, reliable, and ridiculously cheap platform for traders who wanted to be in control. And if you look at their history, it's just been this relentless march towards simplicity. They launched their awesome Kite platform in 2015, and then, just months later, they made a move that changed the entire industry. They made buying and holding stocks completely free. Zero brokerage. That really cemented who they were. Even when they got into mutual funds in 2023, they did it with a super low-cost, index fund-only approach.
And this isn't just some marketing slogan, It's written right into their company policy. It's a hard line in the sand, both for how they operate and for their company culture. It's a huge piece of the trust they've managed to build with millions and millions of users.
So the stakes for messing with this winning formula, they are incredibly high. For fiscal year 2024, the company's CEO shared that they had a profit of around 4,700 crore rupees. To put that into perspective, that's over $560 million US. I mean, this is a phenomenally successful machine. Why on earth would you risk tinkering with it? Okay, so with all this pressure building up, the leadership team sat down and basically mapped out 4 possible ways to move forward, each one with its own risks and rewards.
All right, path A is the purest route. Don't change a thing. Just keep focusing on a great platform and great education. Path B is the middle ground. Maybe offer a light optional research feature with info from third-party partners. Path C is the nuclear option. Go all in and become a full-blown licensed investment advisor. And finally, Path D is to lean into paid educational courses, but still, absolutely no stock tips. So how do you even begin to choose between these?
Well, there's this really useful idea from the world of startups called affordable loss. It's super simple. It just asks the question, what's the absolute most we're willing to lose if this whole thing goes sideways? And when you look at the options through that lens, things get really clear really fast. Path A, staying the course, adds basically zero new costs. The affordable loss is tiny. But Path C, becoming a full advisor, whoa, that's a different story. That brings on massive, permanent costs for things like licensing, compliance teams, and constant audits. The potential loss if that fails is huge, not just in money, but in focus and identity.
Okay, so what about that middle option, Path B, the light research layer? Could that actually work as a business, or would it just be a really expensive distraction? Time to run the numbers.
First things first, you gotta understand how they make money right now. Remember, buying and holding stocks is free. So the profit engine is driven by the paid trades, day trading, and especially those futures and options, the F&O trades. This example math here shows how that all works out to an average annual contribution of about 1,176 rupees from each client.
All right, now let's play this out as an experiment. Let's say Zerodha decides to offer an optional research add-on. They price it low, say 49 rupees a month. A small fee for a small feature. Seems like a no-brainer, right? Well, not so fast. Here's the catch. Once you start factoring in the real costs, like sharing revenue with the research partners, plus hiring more support and compliance people, the picture changes dramatically. At a 1% adoption rate, this feature loses over 43 lakh rupees. That's over $50,000 a month. Even if 3% of users sign up, it's still losing money.
So what's the magic number? The math shows that the break-even point, the moment this feature actually starts paying for itself, is an adoption rate or attach rate of about 3.6%.
And that is the razor's edge they're walking. If only 1 or 2% of people sign up, they've just built themselves a complicated, expensive headache. But if they can push that number up to around 4%, they might just have a whole new, profitable business on their hands.
So all of this brings us right back to the big, fundamental question. This isn't just about spreadsheets and break-even points. It's about what really protects the business for the long haul. What is their real competitive advantage, their real moat?
And it really does all boil down to this one final trade-off. On one side, you've got the argument to preserve what makes you special, your wedge. The trust, the simplicity, that no-tips promise, that's something competitors have found almost impossible to copy. But on the other side, the market is yelling that it needs help, and adapting could unlock new revenue and protect them from future shifts.
Because you have to remember, their moat, their advantage, it's not just about being cheap. It's the whole package. The simple pricing, the rock-solid user experience of their platform, the incredible brand trust they've earned, and the whole ecosystem of partners they've built around it. Any new idea has to be measured against how it might impact all of those things. Which leaves us with one final thought to chew on. In a world where anyone can copy your pricing, what's a company's strongest asset? Is it sticking to the core principles that made you great in the first place? Or is it having the courage and the flexibility to adapt to what the world is telling you? It's a question every single successful company has to answer eventually.
So as we come to the end of this video, a question. Should you be building a house of cards on VC money, or are you building a fireproof business like Zerodha? Feel free to comment. What is the one downside risk that entrepreneurs often fail to manage?